Okay, we're going to look here at employment inclusions, what gets included in your employment income that gets taxed. For this video and hopefully, or I think going forward, depending on your feedback, it occurred to me that we could do these things a little bit faster, at a faster pace, since you can regulate the pace with which you take them in with the pause and rewind buttons on YouTube. So to that end, I thought I would make a lot of the notes first and then talk through them and annotate them as we go. And then secondly, I thought it important to know where in the textbook I'm talking about. So your assigned reading that this is referring to is on the schedule, so these are the things that we're going to talk about today. So also note here that as we talk about the computation, so first thing, computation of income, there's a video on in the before class 1 section of Learn. I think it's called Income Tax Example, which lays out a very, very simple personal tax return, so it'll give you some idea, and so you may want to go there for some of this. So today, or in classes 4 and 5, so let me hive that off. In classes 4 and 5, we're going to talk about employment income. Classes essentially 7 to 17 are all about business income, not usually done in the context of a person who's doing business by themselves. We move it into the corporate realm, but that's what we end up spending most of the course on. And then we do talk about losses in class 13, and then we talk about these Division C deductions in class 6. So you recall that this course is about business tax as a whole, and so we're starting out in the personal realm, but this is really the only piece of the personal realm that we'll spend time on, is the employment piece. And why is that? Well, because as I think was mentioned, the companies are responsible for administering this, and so it kind of has a natural home for us to understand it in the business context. So when we look about, figure out what goes into income, so there's where we're getting to. It's a fairly simple equation of here are the different pieces that can be added up to get to your income. And then we have these deductions that we'll take away from to get us down to taxable income. Then we'll apply a rate to that, and that would be the tax we would pay except for these credits, and then we end up down at tax payable. Okay? So the question now we move on to is when we go to look at employment income is what should be remuneration. So the question is what gets counted as employment income. So I got two scenarios here. So the first is a very simple scenario. So in scenario 1, let's just look at that first. We've got this person, we're calling them employee. So employees spending for the year, and I just made up these numbers, and it's obviously very rough. But here's what he spends his money on in a year. So $45,000 needs to go out. He's got a job that pays him a cash salary. So make sure we understand this is cash salary of $60,000. So he has nothing else complicated going on in his situation, so his taxable income is going to be $60,000. His tax rate, we've said, is 25%, so his tax is $15,000, leaving him with $45,000. Wow, isn't that amazing? Of course it balances, because I just plug whatever he's left over with, he can invest. So if you look at that scenario, you go, okay, well, it's very simple, right? He calculates his taxable income, he calculates his tax, and everything's fine and good. Well, what if the company says, you know what, so let's just change the scenario slightly. Instead of paying you $60,000, why don't we pay you $40,000? You'll continue to provide us with the exact same amount of work, but we'll pay for your house. So we will pay your mortgage, make your mortgage payments for you, which in this guy's case is large, right? It's half of what's going out in the year. So under that scenario, his employment income is $40,000. So his tax is 25% of that, so 10. So he's left with $30,000. To pay how much? Well, he doesn't have to pay this 20, so 45 becomes 25. So he's got 30 to pay. It looks like he just made $5,000. And he did. He's got $5,000 more dollars to do to invest, or he could move that to the fund line on the budget if he wanted. Whatever, he's got $5,000 more dollars. Sorry, this is scenario 2. So if you're the government, you go, wait a minute, that $5,000, that's our $5,000. So we have this idea that, wait a minute, if you're going to pay for his house, that's a benefit. Meaning all you did was shuffle the deck, or you moved the shells around, but the game stayed exactly the same. So we have this idea of benefits, that an employee or an employer can pay an employee with things other than cash. And so it's actually not defined in the Income Tax Act, the word benefit, but the Supreme Court then has had to rule and say, okay, we're going to consider it a benefit if it's a receipt which increases the recipient's net worth. In my mind, so you can take this as the Kevin Markle, if I was a Supreme Court justice, it's when which I never will be, by the way, when the employer pays for something that the employee would have paid for themselves. Okay, so it's basically, it's something I needed anyway. So in this case, he needed a house to live in. They just paid for that. And so it is a bit of a shell game. So here's my example, which I think is becoming more and more relevant these days. The company's going to pay for unlimited smartphone data plans for all managers. So I've got 2 employees, A and B. And A uses this thing all the time. So he's using it for work, yeah, so their work use is exactly the same. But he's also using it at home all the time. And he's just never off this thing. We all know, and probably are, people like this. So his net worth is increased by the government, by the company paying for his data plan, because he would have had a data plan anyway because he needs it. He's addicted. Whereas this guy, he only uses it for business use, and so he wouldn't have one if the company didn't have him have one. So his net worth is unaffected, and so the government has to come up with, or CRA has to come up with ways to, it's the government in setting the income tax law to say, well, we need this to be somewhat fair. And so right now for data plans, it's not. But the classic example, and now we move into this specific section in the textbook, is cars. So cars are something that have been, a benefit, used as a benefit for quite some time. So let's see if we can get our heads around how these work. So there's 2 ways you can go, right? The company can either own it or lease it, and then let the employee use it, or the employee can own it and use it, right? Those are really the 2 scenarios. So a benefit arises if the company owns it. The benefit arises when it's used for personal use. Right? It's not easy to argue that, or it's not hard to argue that. It's easy to understand that. Or when the company pays operating costs. So if the company says, yeah, it's our car and we're going to pay for the gas and the maintenance, then for sure that's there. But in employee-owned, really the only way you can get a benefit here is if, because you're paying for the whole thing, is if the company pays the benefit, or pays for the operating costs. That's the really only way that benefits can arise here. Okay? So then we need to ask ourselves, what value does having a car confer? Well, clearly, we get value when we use it. Okay? But we also get some value from knowing we can use it. So there's the idea that if I have a car, even if I don't use it, I'm deriving value from it because I know that I can. Well, this is easy to put in dollars. this, how do you value this? Well, welcome to our first formula in this class, and this is how the Government of Canada values it. It's very simple. A over B times 2% of C times D plus 2/3 of E minus F. Any questions? So you can see, welcome to the Income Tax Hack. So let's just break this down. Okay, so this is just a factor. We'll look at this last, actually. This is 2%. This is the price, purchase price of the vehicle. Price at purchase. This is the number of months in the year that it was used. This is 2/3. This is lease costs. And this is insurance costs built into, let's just leave it at that. Insurance built into lease payments. Okay? So it's really actually two different formulas. It's if you own it, the formula is A over B times 2% of C times D. And if you lease it, it's A over B times 2/3 of E minus F. Okay, so it's not all that complicated. So what about this factor? This factor, A over B, is income tax-ish, but not too bad. So let's see if we can get our heads around this. So A is equal to the lesser of two things. And you're going to see a lot of this. Lesser of, greater of, and then you have to go on. So we're going to figure that out. So this is personal kilometers and B. Okay, so it's the lesser of the personal kilometers that you drive and B. B is a bit confusing. It's on the surface, but it ends up making some sense. It's 1,667 kilometers times, it's really the number of months, but we do it by available days over 30, which is an approximation of months. Okay, so what we're getting at here, A will be expressed in kilometers, and B will be expressed in kilometers. And we're just trying to get a ratio or a function of them. So in a very simple scenario where the car is available for the whole year, so whole year, we can do this, and we can calculate B. We can say it's 1,667 kilometers times 365 over 30, which is equal to 20,281. So what that tells you is so remember this one up here is the lesser of. So if your personal kilometers are less than, so let's say they drive personal kilometers of 10,000, then our this person's A over B is 10,000 because 10,000 is less than 20. Is that, so let's just call it a half, right? So they're going to pay a half. So what we have to recognize here is that for the leasing and the owning, what you're really getting at here is 2% per, so 2% per month of the total cost. That's what you are getting as a benefit. But you're only getting a portion of that. What portion? The personal portion. So they're basically saying we would expect the average person to drive 20,281 kilometers in the year. If you drive less than that, then you will get less benefit. Okay, that's where this comes from. The lease is simple, 2/3. We can talk about where the 2/3 comes from, but of the lease cost. But we're not going to include in the lease cost the insurance portion of it, multiplied by the same factor. Okay. The last thing we have to look at. So this is what we call the standby charge. So this is the whole idea of the value of having it available. So the whole idea of the part of the value of a car is having it there. The other part of it is obviously operating it, using it. So the operating benefit, operating benefit is much more straightforward, and it's essentially you have two options. There's the kilometers method, which says 24 cents for every kilometer that's personal. Okay, that's what your benefit is. So in our case we had 10,000 here for this guy. His operating cost benefit. This is again only if the company is paying for gas, maintenance, all of those other things, which in this day and age is a little bit rare. So it would be $2,400. Is that right? Did I do that math right? The other one is 50% of the standby charge. So whatever you calculated here as your standby charge, 50% of it can serve as the operating benefit. But this one is restricted to cars that are used more than 50% for business. Okay, so this stuff takes a while to get our heads around, but hopefully this conveys the basics of it, and as you work through the examples in the text, it'll start to solidify a little bit.